What does that strategy mean going forward, whether it's talking about NFL Sunday Ticket or NBA rights when they come up in a couple years? What can we expect from you now that you have this new focus on profitability for streaming?
We have great partnerships with all the leagues, and if we can get a deal done that's accretive to shareholder value, we'll do it. If not, we won't do it.
But are you concerned about some of the tech giants snapping up a lot of those sports rights, which have traditionally been at ESPN?
Actually, I'm not. And the reason I'm not is that I believe that we have a unique proposition that we can offer the leagues, and it plays out. We got new college football rights. We've got new NBA rights, our NHL rights. We've got new MLB rights. NBA's coming up. There's some college rights that are out there, Sunday Tickets out there. But we've done pretty good lately over the last few years in adding rights. So I'm not worried.
So in light of all of this, what you're building in the streaming space, how concerned are you about cord cutting? We've seen consistent, persistent cord cutting. What is this going to do to your business? And how does that impact when you're going to bring some of the content over from linear into direct-to-consumer?
And that's one of the key factors that we watch constantly in terms of knowing when to, as I've said in the past, take your foot off the dock and put it onto the boat. We're doing that slow right now. We've got Dancing with the Stars, which we've moved over. As you know, there's some content that we're moving over to our streaming platforms. And as the market changes, we'll go ahead and evolve with it. We do watch it very carefully. We know where that business is headed, but we also know where our streaming business is headed. And as evidenced by this last quarter, we've got a proposition both in streaming and direct-to-consumer as well as the linear businesses, which, as you know, right now are kicking off so much cash for us to fund our direct-to-consumer investment.
And I know you don't want to lose the linear businesses, which are, the bread and butter of your profitability. And I'm wondering how concerned you are about the crumbling of the bundle even further, especially as more content shifts over to streaming, not just on Disney, but across the board.
We have such great assets, such great networks, such great propositions in the bundle that I think to some extent we're sort of the main factor in terms of how fast that bundle goes where it goes. When you've got ESPN, which, as you know, is the 500-pound gorilla in that bundle, we sort of can help determine which way that bundle goes and how fast it goes. So we feel like we have some degree of control of that.
Well, that's going to be very interesting to watch. Now, one thing we haven't talked much about is your ad-supported business. Ad-supported streaming service launches in December. How profitable will that ad-supported business be compared to your ad-free Disney Plus? And how valuable will those ads be? We heard Netflix saying that they think that their ads are going to be incredibly valuable on sort of a cost per ad basis.
Yeah, well, no one's got the experience that we do because of our Hulu experience, and should be margin accretive as we move over to the ad business. One only has to look at the average per sub advertising revenue that we get on Hulu and think about what that could mean at a Disney Plus standpoint, particularly with the opening price point for Disney Plus with ads. So we believe it will be no worse than neutral, and I think it's got some possibilities. We are really the only folks that I think across the globe have the opportunity to weigh on a lot of history and research and data that we've got because of our work on Hulu. And I think we're going to apply that now to Disney Plus, and I think you'll see great results coming out of it.